and welcome to Morningstar. I'm Emma Wall, and here with me today to give his 3 fund picks is Simon Evan Cook, manager of the Premier Multi-Asset Growth and Income Fund. Hello there.
Hi there.
So what's the first fund we're highlighting today?
Well, the 3 funds I've got today, I'm going to give you a bullish fund, kind of I don't know fund, and then maybe more of a bearish fund. I'll start with the bullish fund, and that's HMG Global Emerging Markets. Now, obviously, if you're bearish about emerging markets at the moment, you probably just want to avoid the region entirely. But the reason why we like this fund is it's got a niche approach. That niche is that it invests in the subsidiaries of developed market companies. Now, why that's interesting is, particularly at the moment, you're getting emerging market valuations, but you are quite often getting developed market levels of corporate governance and support and knowledge. So you're getting navigating away from some of the risks of emerging markets where largely corporate governance, and you're getting that growth potential too. So I think this is a one to kind of put away for the long term and not worry about. If the emerging market crisis gets worse from here, then this will certainly not be immune. But in terms of a buy and hold fund to hold for the next 7 to 10 years, I think this is going to be an excellent fund.
And that's quite a good entry point, perhaps, for those individuals, like you say, who are feeling risky about emerging markets, but would quite like to get exposure to the growth themes that are inarguably part and parcel of those parts of the world.
Exactly, yeah. And he's a value investor, which sits very comfortably with us because we're value investors. And the fund so far is a year old. That year has been pretty terrible, even by emerging market standards. But the reason for that is because the entire portfolio was started as cheap, whereas a mature portfolio will have some stuff that was cheap that's now rallying. The entire portfolio has been cheap. What we're starting to see now, I hope, is that some of that value is being recognised and that relative performance will die down. But make no mistake, if you do look at the chart of this, you're going to need to be brave to buy in. But we bought in 3 or 4 months ago, so you're looking at September last year. I mean, it felt brave doing that at the time. It still feels brave holding it, given what's going on in emerging markets. But I think some of the best decisions you can make in the fund buying world feel uncomfortable at the time.
Indeed, contrarian investing.
Yes, exactly.
And what's the second fund today?
So the second one is one we've held for quite a while now. It's the Polar Global Insurance Fund. The reason we bought this fund originally, I think we've held it 4 or 5 years now, was the valuations of the types of stocks they buy, which are effectively non-life insurance companies, and they pick the best companies within that. I mean, it sounds extraordinarily dull, and that's part of the appeal because there's no bubble in this stuff. It's not like commodities, or it's not like tech stocks where people get excited about it. People don't get excited about these types of companies, and it's been largely ignored by markets. It's effectively performed with how the business has performed, which is well, and it's still available on a reasonable valuation. And at a time when US equities to us generally look quite expensive, but the US dollar looks reasonably appealing, the fact that it's a majority US listed fund, so it does give you that dollar exposure, is a further help. You're not buying overly expensive equities. You are buying very well-run companies, and its track record has been very stable. It's proved to be fairly low beta over time. So we've got a lot of comfort holding this fund going forward when a lot of other stuff feels, quite frankly, uncomfortable.
And what's the third and final stock?
So the third one is Artemis US Absolute Return. This is a relatively new holding for us, run by Stephen Jones. This is, for us, part of a basket of long-short funds that we've recently added into the fund because we think the prospects for long-only equities are relatively limited from here. So there's not an opportunity cost from getting rid of that beta element and buying a long-short fund. We think the returns from here will be pretty similar, actually. So you're not giving up a lot from doing that. Why we like Stephen is he's very much on top of markets. He's very much someone who is aware of what's outperforming and what's not. But he's also, crucially for us, he is at heart a bottom-up stock picker, which is where we ourselves get a lot of our alpha. He's looking at individual companies. He's doing the fundamental research to find the companies that you should be holding, but just as importantly, finding the companies that you shouldn't be holding. The difference being that obviously he can short them in this fund, whereas a long-only equity manager would just avoid them, which is where he gets that market neutrality from. So if you are bearish at this point in the cycle, and we certainly are, at the very least cautious, this feels like a pretty decent option at the current time.
Simon, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.